Welcome, Wycoffians. This is Power Charting. I'm Bruce Frazier, your host. Today, cranking it up into quarter end. Very interesting times, exciting, lots going on. Many think it's somewhat unexpected, but for us, we've been talking about this a long time. So let's go back and look at some of the charts that we've done, bring them up to date, and then discuss whether or not this market can keep working its way higher. Okay, the Fed. Is the Fed done raising rates? Yesterday they had a Fed decision to pause, and they talked about it being temporary and that there were more rate hikes coming later in the year. I think that they had to say that. We had said here right after the last Fed meeting that the Fed was done. Now, I'm no prescient Fed watcher. I'm no better than anybody else. Probably most are better. But what we can see here on comparing the 2-year yield to the Fed funds rate is that once the 2-year yield stops rising, the Fed stops. So the Fed has been trying to catch up. If you look here, the Fed has been trying to catch up with the 2-year yield as it's been zooming higher because of inflation pressures now since 2021. And now we see that, I'll draw this above there, that the 2-year has stopped rising. Consequently, a meeting or two after that, the Fed steps in and says, oh, we're going to stop, watch, see what happens. But it appears that if the 2-year continues to stall at these levels, that we will be done with the rate hikes. Now, does this mean, as you can see, that often the worst bear markets come, this is the S&P, after the rates peak out and start to drop? We've talked about that in the past. Want to make a point here that if interest rates can go sideways in these levels, as it did here, that the market does have a history of being able to rise in such an environment. And actually, this was a very good environment, 2006 to 8, for materials, commodities, oil and gas, and so on. So, and other areas, home builders, not dissimilar to today. Looking at today, if we can get a sideways 2-year yield where it goes sideways rather than turning back down, then it could very well be that we're in a period where the stock market could continue to work its way higher. And we will be watching that very, very closely. Do keep in mind, just a note on this chart, is that these two scales over here, one for the Fed rate and one for the 2-year treasuries, are slightly different from each other. So they don't perfectly align and match for yield levels, but that's not what we're looking for here. We're looking for trend, and when trend stops and when trend turns, and that will tell us a lot about what the Fed will do next. Okay, enough of that. Now, here is the S&P 500. This is a point figure chart, 3-box reversal, 25-point scaling. And you can see here that this is actually through June 14th. Now, 2023, what I would like to do is I would like to put up this chart, which is from January of 2023. And this chart shows that we have in fact been counting the structure that we've been in since 2022 as an accumulations type structure. And so remember, keep in mind, this is a chart from January. Distribution across this area and here too, we've counted both of these. But on this chart, we counted the redistribution, beautifully nests in this area, and that is where the lows of our structure have occurred. We have looked at this as an accumulation style structure. We have taken counts appropriately. Here is a smaller count. We've segmented them. This count goes 43.25, 45.75, And in fact, we have just cascaded into that area now. So we're in there, and I'll show you some other charts that will update the action. But we take larger counts, and we can see here that if we take these larger counts, that they go up 21 columns, goes up to 5075 to 5350. This is the high of the prior bull run, 4800. So this constitutes a new high. And that's quite interesting, is to have the potential, a point figure potential for new highs from the S&P 500. And we're not even counting the whole structure until we get up here 37 columns. And I like to take it a piece at a time. But so far, so good. And this larger structure, which this, and I'm not even showing you the most current data, that structure goes 6275, 6550. Stay tuned, because we will update these point figure charts, especially now that it appears that we've jumped up and out. You can see that this chart's up to date, June 15th. This is one box reversal. So we call it a swing trading count, because we're trying to pick up these shorter term time horizons. This count down here was around September, October, November of 22. And this area here counted up to 4100, 4350. We had indicated that we thought that that 4100 area was formidable resistance. I'll show you why more on a vertical chart here in a minute. But this now has been exceeded. Look at how it wedged up into this resistance area, and then resolved itself with a really good jump up and out of this area. We have a second count that we can take. This count is another swing count, goes 4,500, 4,750. So we see 4,400 is what we've just gone to, and we 4,500 is right here, and we don't know whether it could go minimum or maximum count, etc. But we're headed in that direction, and there's excellent momentum in the market at this time, which tends to drive prices persistently higher. Okay, with that, let's keep moving on. This is a chart we've been using for quite a while, actually into 2022. And note that we have an excuse that I've cut off some of these notes, because this actually is a very old chart, updated to June 15th. But this is an accumulation structure that we have been documenting really since 2022, and showing how we've been using the Wyckoff method for being able to identify the critical moments or zones in the chart, and how a Wyckoffian would interpret them. So this resistance right here is a very important high off of preliminary support, establishes a resistance zone. We immediately drew a resistance line, that red line right there, and you can see how well it's been following this resistance, or adhering to it, since May, June of last year. And because of our Wyckoffian nature, we immediately wanted to draw that resistance, because we knew it would be important and come into play later. It came into play right in August of 22, where it upthrusted that level, where I put this red check mark, and it upthrusted it, went up to the downtrending channel line, which you see there, and then reversed down very hard all the way to support September, October. I'll have more comments about that period here in a minute, but set up a swing trading count. There were green shoots in that area, which we documented here on power charting, these green shoots, and you can see this is stocks above their 50-day moving average, one of the tools we use to identify green shoots. And note how it's turning up when prices are still going lower in the index. So that is one of the ways that we see green shoots. And when rising prices on the 50-day cascading higher show up, we go with that trend. Now, it got up to this 4100 level here, and stalled at the trend line, came back down, made a higher low. Such an important event to come down into a higher low and not return back to the September, October low prior. Now, I'm going to talk in a minute about why this market could go up into the face of the Fed being so restrictive. But let's keep going. I'm running out of time. I have a lot of charts to show you. So we have a sign of strength here, goes above this level. That's why we call it a sign of strength. It's right up into the resistance of this 41. It's around 41.75. Pulls back to another higher low. And now since March, it's been working its way up ever tighter. We call this a backup here. It's a tight, dull, quiet, cannot show any kind of supply being present in the ability to go back down again. This is a massive change of character from this decline, and certainly this one. And this has climactic qualities in it. So we look for those characteristics in accumulation, which shows that absorption took place. And that is what we think we are seeing here, is absorption. Now, this is the same chart, S&P 500 again. I just want to show you one thing, and that is the importance of the quarter and year ends. And so I have notated the quarter end important low. This is 2021, October. Year end, very important high, the final high for the bull run right there at year end. And then go look at the quarter end, look at a peak here in 2022 at the end of the March quarter. And then June, 2 weeks before the end of the quarter, we have a very important low, another important low at the September, October low. And we always say that we look for the low to come in plus or minus a few weeks of the end of the quarter. This is all happening because of institutions. Institutions are trying to get their portfolios in a proper state called window dressing for their clients. It's sad that they do this, but they do it, and they try to justify the positioning they have with the stocks that they own, but they've just bought them at the end of the quarter or sold them. So here we see at the end of December is a very important low at year end. But if you look at the NASDAQ 100, the NASDAQ composite, this low actually almost went to the September, October low. And that was a very important low and opportunity to buy these big 8 super market cap stocks and the others that have been performing so well in 2023. So now look here, we have a quarter end here, 2 weeks before, 2 to 3 weeks, we had an important low. Well, where are we now? Look at this quarter end. So we have a quarter end here that is coming up, and note how the market is accelerating into this mid-year quarter end. I think this acceleration is institutions trying to get their portfolios right, doing window dressing and rushing into stocks at ever higher prices, and that is really helping to drive up the indexes. My contention is that at around quarter end, plus or minus a few weeks, and I'll show you seasonality in a minute, we are going to have an important high that is going to stop. Now, it doesn't mean it's going to reverse, but it could stop and have to spend some time building a cause. Show you more on that later. Okay, here is semiconductors. We talked about them a few weeks ago, and this May 25th chart is a chart we did at the time. So 2 counts, they're both swing counts, 128, 138, stop the advance here, nice swing trade, and then another swing count. This count takes us 160 to 168 on the VanEck Semiconductor ETF. SMH is the symbol. At the time, it was at 138, just coming out of this count structure. Okay, what has happened since? Well, now this point and figure chart is a little more esoteric in that this is a very, very long period of time. This is a 3-box reversal method that picks up the high of the bull market in 2021, and I put in a trend channel off of these 2 points right here and here. Beautiful, throws over the top, comes back in, has another run up into a climax at 156, stops the advance, tests it, and fails. And so this is distribution. If you take a smaller structure, if you do 1 box or 2 box reversal on this, you'll see a lot more detail. But note how we can be really quite, we can go to 4 box reversal, and these point and figure charts are very durable, still very useful. So we're only counting 5 columns here, but look at the count that we get. It goes right down to 180 to 80 to 96. Stop this count, stops the decline, gives us a good automatic rally, and then a climactic type event into 84 with an 80 count low. Counts right into the objective range. Now, do we have a count here? Well, we have a great count, and this count takes us up to 144 to 160. We are now into the middle of this count objective range. So we need to be looking at the semiconductors as having fulfilled the objectives that we have shown on this initial low. This count could be counted larger. I believe that this 156 will prove to be resistance, and it is also a count objective area for a point figure chart. Here is a vertical chart of semiconductors, trend channel, and this channel, well, we have 3 types of resistance overhead here. Note, well, and actually maybe more than 3, because we have a relative strength line underneath. Note that it keeps making new highs, which is very bullish, and it's gone up and it's returned to the overhead reverse use of trend line here, and that'll be a form of resistance, as it was back in March. This is going to be a form of resistance at the top of this trend channel. The prior high is a form of resistance, and that is going to come into play. And we have point figure swing counts that take us up to this level. Does that mean the market has to stop and go down? No, it could very well just stop, build a cause, and then begin to move higher again, somewhat akin to what has happened here in February to May, June. And so beautiful swing structure here, nice hinge type action, beautiful chart. All right, well, let's turn to technology. Now, technology has a lot of semiconductor in it, and so it looks very similar. I want to really make the point with this chart and also the prior semiconductor chart that we have real acceleration taking place here, pretty high volume, a lot of demand, ease of movement higher out of this accumulation structure. So, and this is a chart that I have been working with for a long time. So we have a beautiful accumulation structure in technology, and it's been the important leader in 2023. So we have resistance up above this level in the form of a trend channel, a resistance at the prior high, and we would expect a pause up here in this yellow shaded zone. And also because of climactic behavior, I believe that it's going to need to have some kind of a reaccumulation structure, build a new cause for a new move. And this technology chart, I think, is just really a fascinating chart. Relative strength is just really, really good. Here you can see underneath, and it continues to suggest that once this pause is done, technology could continue to be a leader. Very cool, very interesting chart, important accumulation structure. It's massively large and would count to much higher prices. We look at the Fed, we look at the economy and all this, and we go, how is it possible this could happen? And, you know, the key to Wyckoff is that we love to look at charts. We analyze charts uniquely just in their own structures. We let reasons be optional, and there is no reason why the market is going up here, but there is, and let me show you why here. with this fear and greed chart. This is September 29th of 2022. And the pessimism is fantastically deep. Extreme fear in the fear and greed index at a reading of 14, slightly lower in this April-May period, where I think it got down into single digits. I have the data somewhere, but I believe it was like 9 or 7 or something. But here, 14, and we showed this at the time. We wanted you to see this because pessimism is an incredibly important technical, tactical tool for us, because what it demonstrates is that institutions, large informed interests are really fearful. Note it's coming right at the end of the quarter as institutions are selling off their weak holdings, window dressing into the end of the quarter. They're also kind of creating their own weather, because the fear that's associated with that decline means that these large institutional interests have lots of cash. They're raising cash away from areas that they don't want to be in, and those are probably the areas to invest in, as a contrarian would think. So what subsequently happened after the fear and greed got down to this 14 level? And note down here, here's the S&P, and look how, ignore this WMD session, October 19th. I do want to tell you though, that just for you, we are going to have a free WMD session coming up in the next month or so. Stay tuned. As soon as I know the date, I will announce it to you, and it's going to be a lot of fun. Roman and I do these every week, and we want you to be there for this one that we're going to make available. So note here, end of October, slightly lower low than the June low, last quarter's low, and September 2022, lower low, extreme fear. That means there's a lot of cash on the sidelines. What happens next? Well, let's see. Here's the low right here. It was almost exactly the low. And note, this is that low we just looked at, end of September, went down one more time in the S&P, but the fear and greed was making a higher low at that point. And then off it goes, and up into the resistance area of around 75. This is what the S&P has done since. And as of the June 14th, extreme greed, 81. Don't you love it? God, this is a great business. And so 81, here we are near resistance levels. It could go higher. It could absolutely go higher. I think that because of the technical resistance levels that we just defined, that it's likely that we're somewhere near an extreme for the moment, and that we will back off of these levels, as we have in the past, here and here and here. But this is really good because it's going a little higher than it did prior, and showing that there's a lot of enthusiasm for the markets. Now, another form of sentiment that I want to talk about, because this also really illustrates the notion of when there's a lot of cash in the system, because cash is the thing that's needed to fuel higher prices. It's when the market is fully invested, when investors are like completely loaded up with stocks, maybe on margin, that there's only one decision they can make, and that is to sell stock. And that's like December of 21. Down, when you get into an extreme period of deep pessimism, they've raised tons and tons of cash all the way down, and they have fuel to drive prices back up at a later date. So here is the National Association of Individual or of Investment Managers, National Association of Active Investment Managers. These are market timers, and I have spoken to their group before. They are really good at what they do. They are primarily trend followers. So they started to raise cash. They did not have maximum bullishness in late 21, which is a sign that they were already worried about the market. and they were raising cash on the way down, had a high level of cash, and their exposure was substantially low in the second half of 22, and that means they had a lot of fuel in the tank. And because they are largely trend followers, they were going to follow the trend up, which is exactly what they did. And this is an excellent strategy. And they have, as you can see, started to increase their exposure to stock prices up, up, up as the market has gone higher, higher, higher. Well, the question is, how high can their exposure go? Is there still more cash available? I think this 2018 period is really a useful analog for the present for exposure, because the Fed was tight back here. And I believe because the Fed is tight and has been tight, that we have to look at the analogs of when the Fed had high interest rates. And this was such the case back in 2018. And you can see the exposure index, and I drew the red shaded area across here so you could see. I still think there's fuel in the tank. There's cash available to drive prices up higher to this 80, 85 level with a hostile Fed, using a term, and that there's still potential to move higher in such an environment. Now, keep in mind that once you got up to those levels, this was a substantially nasty decline in the fourth quarter of 2018. Really, and notice how the high came at the end of the quarter, the low came at the end of the next quarter, and then a really, really good run. So I believe that there is still fuel in the tank for higher prices. And with that, I'll say so long for this week. Have a great week, and I'll see you next time. Thank you.